Hello, Eric. How are you?
Morning, Adam. Good. How you doing?
Good, good. Well, this morning I went in early to New York City to attend the morning meeting of one of our biggest accounts, and Eric joined in remotely by Zoom, and I relayed to them that every time we met, from my recollection, the market made a bottom. I recall having some serious discussions about things that were going wrong and trying to explain why things might not be as bad as they seemed. This time around, everybody was a little calmer simply because we're kind of getting used to the noise and turmoil coming out of Washington. Eric and I have been arguing that the market would be choppy during the first half of the year as we kind of got the lay of the land with regards to Trump 2.0. And sure enough, it's been choppy, but it's been choppier to the downside maybe than we expected. Though we were talking about a correction late last year. We thought it would kind of happen in January, so it maybe took a little longer to happen. But now we still think it's going to be choppy, but maybe choppy to the upside here as Trump says some soothing words like flexible, that these tariffs that are going to be imposed will be a kind of a flexible situation and negotiable perhaps. So we'll see how that plays out. Obviously on Friday, the market went up on at least a one-day Trump put, where he said that where he mentioned the word flexibility with regards to the tariff issue. And then on Sunday, we had the Wall Street Journal article that said that instead of kind of a shotgun, scattershot approach to tariffs, the administration is going to focus on 15 countries that have surpluses with us and do it that way. Eric, you're doing some work on Scott Bessent for tomorrow's morning briefing. Any insights from what you've gleaned on where Bessent is on tariffs and other issues?
Yeah, I mean, he's done a little more longer form stuff this month, which he makes certain headlines and then people freak out after like a 30-second or a minute long hit. And he recently went on the All In podcast. He did like a longer Face the Nation interview. So just kind of elucidating his views a little more. And like they're pretty sound, like it's more theoretically in terms of what you'd expect like a typical Republican to think, how, lower tax rates might be offset by banking deregulation and stronger economic growth, kind of the path for the deficit going forward. So, I think there is an overarching plan, and he is cognizant that, President Trump doesn't take a straight line towards things. It can kind of seem like gyrations and a little more volatile. But there is kind of a path going forward. And I think that's reflected by the flexibility in tariff negotiations. I think they're just going really strong out the gate. And the first 3 months is just, the first 3 months of a 4-year term. So, yeah, I don't know. There's a lot of fears about an independent Federal Reserve after the 2 FTC commissioners were fired. There's, I don't know, a lot of speculation about the dollar's demise. And I think you're probably better off focusing on more like near-term issues.
There's something about a 100-year bond or something like that?
Yeah, there's a proposal for a century bond. So if you're a foreigner or like a foreign government who holds, 10-year treasuries, we'd basically implore you to hold, a 100-year bond, and there'd be a lower rate on that, or we'd withhold a very small portion of interest payments to try and lower the, interest costs for the U.S. There's been a lot of talk about it in the media because it's a novel idea, and you can speculate about how this might unravel the dollar's role as a global reserve currency. I don't really think it's that big of a deal. And something I outlined in the morning briefing is that it actually relies on the Federal Reserve's independence and swap lines that provide dollars to the rest of the world. So you can't both be worried that the Fed will give dollars to the entire world and also worry that like century bonds will unravel the dollar's independent or status because they kind of go hand in hand. So in any
Yeah.
case, I don't even think it's an issue until next year at the earliest.
Well, Powell's term expires next year.
Yeah.
I think isn't it? Is it February or March, something like that? Uh,
Q1, let's call
yeah,
it.
yeah, sometime around that period. You think Besant might want that job? Is that a job with kind of a classier, more upscale and longer term than being at the Treasury?
I feel like Kevin Warsh is probably the guy who's most likely, given he was a Fed governor for so long, and then maybe Hassett, because like the NEC is kind of a place where you might wait to go somewhere else. But I
Isn't
mean,
there, isn't one of the governors apparently angling for the job given
yeah,
his
yeah,
dissent?
Waller's making his case, I guess, by dissenting on every possible route. He was the only dissent on slowing the pace of quantitative tightening,
Yeah.
which is really just a formality, right? They're just, with the debt ceiling, they don't
Mhm.
want to, put bank reserves in an odd place. So they're just trying to slow it down for the time being. I think it makes sense. It's an appropriate approach. But I mean, they elevated Mickey Bowman, put her as the vice chair for supervision. She's a good governor. She's aligned with a lot of the things we've said on the economy. She'll be focused on very thoughtful deregulation, and making sure
What's her name again?
Mickey Bowman or Michelle
Yeah.
Bowman.
Yeah. Yeah,
So yeah, I think
we've kind of liked her work.
yeah,
She seems to be very reasonable.
yeah, no, I mean she's basically been on the whole same side of the productivity story and the
Hmm.
economy's resilience as we have. I
Yep.
think she's focused on the treasury market and banking system being stronger through deregulation, but like not just across the board, deregulate everything, do it in a thoughtful way. So she's a good pick, and I think they'll replace, Chair Powell with someone
Mhm.
who's, normal or like
Well,
a.
yeah. Well, we're talking about the Fed. I see there's a question from Ian about QT. Any updates on what's going on in the background on QT?
Yeah, so they slowed the pace of balance sheet reduction. They're only going to let $5 billion of treasuries roll off for probably through Q3, at least until the debt ceiling is resolved. And they're going to leave the MBS side of it untouched because they don't want mortgages on their balance sheet, and very few have rolled off because no one's prepaying.
Mhm.
So it makes sense, and it's also not a huge deal for the 10-year yield. QT raises yields, all else equal. As we've noted a lot, and people have talked about, the Treasury issues a lot more bills these days. So arguably QT hasn't had as much of an impact, but
Right.
they're just waiting because the TGA, the Treasury's account at the Fed, is being spent down as extraordinary measures are funding the government. Eventually, it'll have to be built back up. That could drain reserves very rapidly and potentially lead to some mishap in the dollar funding markets. They want to avoid that. So they're just kind of taking their foot off the gas for the time being.
Sure.
It's really just like monetary policy wonkiness. It has nothing to do with, I think, the real economy.
Yeah, I think maybe we should go back and look at the the press conferences, the FOMC meetings. It seems like the during the day when during the presser you get a lot of volatility in the market, and sometimes it's up, sometimes it's down. But it seems like we've had a string of these things where the next day or the next couple of days the market does better. And I think the message that came across from Powell's press conference on Wednesday was what we've been saying for a while here, that the Fed is remains on the dovish side. They keep saying, and he said over and over again that they're in no hurry to lower rates. But the key phrase was to lower rates. He didn't say there were no hurry to do anything, which would mean that they are considering keeping rates flat. He didn't say we're in no hurry to raise rates. He said we're no hurry to lower rates. So clearly, the bias in their thinking is that they should lower rates. They're going to have to lower rates for one reason or another. But as he said, the economy, from his perspective, is in a good place. So there's no reason to rush. I was a little concerned that he used the word transitory again. I think everybody kind of got freaked out because that was almost like a jinx. Because as we know, back in 2021, they were talking about inflation being transitory. It wasn't really much of a problem in 2021, but I think it was later in 2021 that there was some discussion of it, and Powell kind of blew it off as whatever it'll be transitory. Well, it turned out to be fairly persistent in 2022 and 2023, and we're still talking about it, at least wondering whether we're going to get to that 2% or not. So that was an interesting choice of words, but he basically argued that inflation would be transitory if it was boosted by tariffs. Um, just kind of go over our thinking on the Fed's forecast of the economic outlook.
Yeah, so they updated, their quarterly summary of economic projections, the SEP. They slightly lowered their growth outlook. They're expecting sub 2% real GDP growth for the next few years. They've been pretty bearish on growth this whole time,
Yeah.
expecting only like 2.1% real GDP growth. We obviously far surpassed that last year. And we're basically there in terms of productivity growth anyway. So even if you assume the labor force doesn't grow at all and productivity growth doesn't accelerate at all, we're already going to do better than the 1.8% expectation that they have. So we're obviously much more bullish
Yeah.
in terms of
It seems
productivity.
it seems as though what they're really communicating in their SEP is that they think that if they think that the Fed funds rate is restrictive. That's really the important point that comes through again. They maintain their longer run federal funds rate at 3%. So that's that nirvana rate, that neutral rate, the rate at which the economy remains at full employment and at which inflation is pretty stable. Well, we're kind of there, right, Eric? I mean, we've got the unemployment rate at 4.1%. It's been, zigzagging around just around that level for many months now. Labor market seems to be fully employed, and yet we're still creating jobs. And then, of course, the inflation rate remains moderate compared to where it was 2 years ago. And it's kind of close to 2%, not exactly there. Maybe it gets sticky around 2.5 to 3%. Nothing that's really earth shattering. And so we're kind of at nirvana. I mean, our argument has been that empirically speaking, you can't really measure the neutral rate. All you can do is kind of judge from the data whether you're there. And for some reason, Fed officials think that the neutral federal funds rate is below where they are now, that they need to cut a couple of times this year, maybe a couple of times next year to get down to 3%. Notwithstanding the fact that the economy is doing absolutely fine. So that I think is where the bias towards easing comes from, is their perception that if they don't ease, that we might have a recession. And that I think was reflected in their downgrading economic growth. And again, as you said, it's below 2%, which seems awfully pessimistic for no good reason, since we've actually been doing 2.5 to 3% for a while. And they seem to be saying that they'll have to lower rates, otherwise there'll be a recession, and that was also reflected in their slightly raising their unemployment rate. So the way they're looking at it is they're going to have to lower rates. So I think the market read into that just a confirmation that we've gotten before from the Fed, that the Fed put is on standby. So when they say they're in no hurry to lower interest rates, they said that they're basically saying if something this comes around that says, well, we better speed it up, they will speed it up and they'll do it rather quickly. So on Wednesday, I think we basically got some confirmation, some you know some talk about the Fed put being still out there, and then on Friday we got at least a 1 day Trump put when he used some gentler wording when it came to the tariffs. And by the way, Eric, it seems like he thinks this. He said it many times. He thinks tariffs are beautiful. They're amazing. They're really cool. He seems to have some sort of obsession with tariffs, but they are working for him. I mean, he threatened to impose tariffs on Mexico if they don't do something about their southern border. And let me turn that off. That if they don't shut off their southern border, which they did, which then dramatically reduced the flow from our southern border. And now he's talking about any country that imports Venezuelan oil will slap a 25% tariff on them. So this is kind of the new stick. Then I think it was Teddy Roosevelt said, what did he say? Something like uh, use a loud voice and carry a big stick, or I know the other way, right? You use a soft voice but carry a big stick. Trump kind of uses a loud voice and carries a big stick with tariffs. Anyways, anything else you want to add, Eric, before we just kind of breeze through some of the charts?
No.
Okay, let's go for it then. Max was here, but when I told him we were going to talk about tariffs and Trump, he said he's heard it before. He's not really interested, so he's left the room. Here we go. Okay, here we go. So we've got I'm getting attacked here by calls. So figure one is just the S&P 500. We took out the 200-day moving average. Looks like we're bouncing back. I guess we'll see if we can get through that 200-day moving average. I guess if we don't, we kind of bounce back down. Everybody will freak out. The technicians will, anyways. But we'll watch that. The Nasdaq also did that. It broke through this channel that I drew. I'm not going to blame you for any of these amateur technical lines, Eric. I'll take responsibility for them. And obviously that didn't hold, but we're not convinced that we're still not going to be back on course for getting to 22,000 on the Nasdaq, maybe by the end of the year. I mean, good things could happen to good people. This shows that in a lot of the correction was the Magnificent Seven. They weren't so magnificent since mid-February, and they were down by 14, 15%. Meanwhile, the S&P 493 were a little bit more leisurely and basically flat. We had been talking for a while about a rotation out of Magnificent Seven into the 493. Instead, what happened is we had a rotation into Chinese stocks and German stocks, and we acknowledge that, and we acknowledge that stay home didn't work here for the past several weeks, but we're not convinced that the Chinese economy is really lifting, nor that European economies are lifting. Germany still has a big problem with the auto industry over there. We're competing with some of these Chinese auto companies. As well, we don't have that problem because we don't import any Chinese autos, but Europe does, and that's creating a problem for them. Also, it's hard for the Germans. Used to sell a lot of cars in China, and now they're facing a lot of competition from Chinese manufacturers. There's a car company there that's building apparently a city to build cars and it's supposed to be the size of San Francisco. So they certainly think big over there. Meanwhile, the corrections occur when the market starts to worry, where investors start to worry about a recession. You get the PE going down. The E still holds up, which is exactly what's happening right now. And meanwhile, here's the E. This is the forward earnings of the S&P 500, all-time record high. We monitor it monthly and weekly, and that is an awfully good correlation. It tracks really closely to the coincident economic indicators, which is really a monthly way of just assessing what GDP is doing. It rose to an all-time record high in February. So, latest kind of hard data suggests the economy is doing just fine. That's through February. I guess we'll see whether some of this tariff turmoil starts to erode some of that growth. But clearly, it's had an impact on forecasters. So around mid-February, everybody, including ourselves, was right around 20%. A couple of weeks ago, we raised it to 35%. You can see this is poly markets, by the way. We think it's kind of a neat daily way to assess what the consensus is, at least of people who are playing this game with poly markets, and they are up to 35% roughly. This is another issue with regards to the forecasts. The markets freaked out on recession concerns because tariffs might be inflationary, so that puts any Fed put on hold, not just on standby, but on hold. How can the Fed ease even if the economy slows significantly? If unemployment goes up, how can the Fed ease if inflation is actually going back up again? So that's an issue. But the consumer sentiment index, as we've argued, is very partisan. It's become increasingly political, and the Democrats in that poll are very depressed right now. Republicans are much less depressed, but the Democrats are much more depressed than the Republicans are happy. So, anyways, we're not taking this too seriously. It's available through March. It started to go up in February, but the February data wasn't so bad for the FRB New York consumer survey. Powell, by the way, in his press conference said that he thought that inflation expectations, long-term inflation expectations, were actually well anchored. So he had both those data points, and he didn't particularly stress out about the short-term inflationary expectations. Market still looking for 3 cuts now over the next 12 months. Basically, over the rest of this year, will be 2 cuts. We're still none and done, but we're flexible on that. If the president can be flexible, we can be flexible. We talked about these things, the Fed's projections. So you can go through that on your own. This just shows the civilian labor force. I don't know how accurate this is with immigration, deportation, with all the things going on, but it is what it is, and it shows that the labor force is growing somewhere between 0.5 and 1% on a year-over-year basis. So, real GDP's arithmetic is really simple. It's the growth rate of productivity plus the growth rate of the labor force. So we've got, let's say the labor force is in fact growing 0.5 to 1%. Productivity is growing kind of back to its historical trend of 2%. 2% plus 0.5 to 1 gives us 2.5 to 3% real GDP growth, which is what we've been getting. We think that continues this year. Maybe the first quarter will be somewhat weaker than that, but we're still blaming the weather in January and February for some of the weakness in consumer spending. Moving on here, I think we kind of covered all these issues. That's the inflation story. Okay, Eric, why don't we, this time I left a little bit more time than usual for a little Q&A, so why don't we have a fireside chat with our friends who tuned in. And we've got 5 questions so far. I think we got time for a few more. So go ahead and send them in. Go ahead, Eric. Eric, you're on mute.
All right, there we go. This is a good one. So Ed, do you think the market can bottom without a real flush out? The sell-off's been pretty leisurely compared to last year's corrections, such as the yen carry trade unwind and then the 2023 banking crisis.
Well, none of those really turned out to be all that terrible. Kind of corrections. I mean, we had that terrible bear market in 2022. That certainly was painful, but we made up for it with the bull market we've had so far. I mean, this was kind of like a little bit of in the gut. There was a little twinge in my gut, and as this market went down, we did flinch and raised our recession forecast from 20% to 35%. Don't really regret that. We think that kind of reflects the potential impact of Trump turmoil on the economy. So we'll acknowledge that, and we don't, I mean, we don't know what to believe anymore with regards to what Trump says. For a while there, he was saying that he was implying the tariffs are going to be permanent to raise revenues and to force companies to invest here and to manufacture here. And I think that's still the game plan. But looks like the word now is flexibility. My hunch is that Trump still, for all the talk about Trump not looking at the market and claiming he's not looking at the market, he's still looking at it. Who's kidding who? And so all of a sudden, this more flexible talk certainly helped to give the market a lift. But if there's not going to be a recession, there's no reason to have a wipeout here. Again, as we've said, corrections occur when investors fear a recession, but it doesn't happen. And we think that's the environment we're still in. Of course, we had a fear of a recession in 2022 that didn't happen, but we did have a bear market. So it's not as though that scenario can't be repeated again. But we're counting on the resilience of the economy to impress people once again, and to show that the economy is actually stronger than the Chinese economy or the European economies. And so maybe the stay home will start to outperform the go global, and maybe the dollar will start to firm up. That's certainly the kind of day we're seeing today. But let's move on, Eric.
We got one from Sal asking, do we see any potential impact on the S&P 500 earnings from onshoring? And if so, how fast could that show up?
Yeah, onshoring has been kind of a slow motion process. I mean, you can see it anecdotally in plants that are being built in semiconductors. There's certainly, every day we seem to have some country, raising their pledge flag. You feel like you're at a charity event where you're all sitting around the table and Trump is at the podium, and you're lifting your card up to say that you're going to contribute more. So that seems to be what's going on. I don't know that onshoring is going to have a meaningful impact on S&P 500 earnings anytime soon. As we just looked at forward earnings, and they look pretty good to us. All-time record high, still going higher. The only time that they're misleading is when we fall into a recession. And if you agree with us that we're not falling into recession, then the outlook that the analysts are providing on earnings is probably a pretty good forecaster of where we're heading. So far, so good.
I think we can wrap up with this one. Just like, what do we think about, the rebound in European equity markets, which is based on a lot of fiscal and defense optimism, but we were pretty adamant about a lot of the drags on the European economy last year. So how are we thinking about the interplay between those?
Eric, you've written some of that recently. You want to just kind of go over that?
Yeah. No, I mean, I think the optimism makes sense, especially if there's, a lot of, if it's a rotation trade from really highly valued US stocks into fairly cheap European stocks. I think a little bit of a rotation in the context of US trade uncertainty makes sense. There's, some deals have been made, but it's going to take a lot from the EU to actually implement these, and we'll see how that goes. And it's not, a lot of these economies have been growing pretty slowly. The UK is obviously outside of the EU, but the UK contracted in January, like minus 0.1%. Germany's industrial production's been falling for the last 5 to 7 years because they're struggling to compete with China. And even if China boosts consumption, they're still going to try and export their way to growth and export their way out of deflation. So those drags all still exist, but if you're a cheap stock, you're slightly less cheap now on the back of that optimism. So we're still
Yeah.
staying home in U.S. stocks, but it makes sense to kind of slightly, be less pessimistic, I suppose, on Europe.
Yeah, I mean, look, the reality is a good chance we're going to overstay our welcome and stay home, home, home sweet home. We kind of feel comfortable overweighting the U.S. But it just no the economic the stability of the economy, the strength of the economy, its resilience, the capital markets, the availability of funds for venture capital, and all this money that's being pledged to come in here look pretty good to us. And it certainly looks as though the markets over the past several weeks seem to be signaling that this whole tariff turmoil was going to put the United States into recession, or at least increase the odds of the United States in recession. And yet, everything was going to be hunky dory in China just because the Chinese government is committing to stimulate the consumers, which is going to be pretty hard to stimulate because old people don't go anywhere and they don't spend much money. And they've got a big geriatric population issue there. Europe has the same kind of population issue. And in addition to that, they got the clash of civilization. If you're going to have immigrants, it's kind of nice if the immigrants actually want to be part of your culture and integrate, but that's not the case in the kind of migration flows that have occurred in Europe. So it's kind of a clash of civilizations. And a lot of the pro-growth initiative is coming out of the government bureaucrats, and they haven't done a particularly good job of managing anything. I mean, their managing of the transition from fossil fuels to clean energy has been a total disaster. And so here they're all of a sudden say, let's spend a lot of money on AI and all that. Um, Look, speaking of AI, it looks like the Chinese are just going to kind of flood the market with open source AI. So nobody's going to really make money charging $20 a month for the LLMs specifically. But we just signed up for a Claude anthrop, anthrop, anthropic, a Claude Anthropic service that just inputs financial data into their model so that they don't get a lot of garbage information in there, and we're feeding it some of our own information and just limiting the model to that information. So we're toying around with that and looking to see how that all plays out. Maybe the Chinese have come up with a battery that recharges in a few minutes, and that might be a game changer for the global auto industry. But Europe, particularly Germany, is very dependent on the auto industry, and as I've mentioned, they got some serious issues in that regard. Eric, you want to take Maxime's question?
Yeah. So on French inflation, and I guess we can broaden it out to Europe. Do we see it going negative and heading for deflation? A lot of countries have, disinflation going on right now.
We see disinflation. We don't have any particular reason to think about deflation right now. Though, well, I mean, we do have a particular reason. I mean, tariffs historically have actually been deflationary. They haven't been good for global economic activity, but the jury's out on whether that's where we're going. I don't think we're going to go there, so we'll take it from there. Eric, thanks as always for joining me. Thank you all for joining us, and let's do this again next week. Have a good week. I think it should be a better week than we've had the past couple. Thank you.
Thanks, everyone.